Etsy shares have been declining for some time. They have fallen by 80% since 2021 and by 60% since 2023. According to Morningstar, Etsy has a wide moat, meaning a sustainable competitive advantage. This video is part of a larger video about fashion stocks that are currently in a negative trend. It is not the most interesting, but still quite interesting. It receives 4 stars from the Morningstar rating. They have also indicated that according to their analysis, the fair value asset is still around $100, while the current price is close to $50. Analysts are somewhat less positive in the short term and give a price target of around 64. If you have been investing in Etsy for the long term, this stock has probably caused you a lot of frustration because it is indeed quite a good company. It has a competitive advantage with their entire community of handmade products that people create themselves and, of course, promote themselves. Etsy has launched a number of interesting features, such as the gift mode and also the ability to advertise on behalf of your webshop. But there are, of course, large competitors, and I personally have no position in Etsy, but I do have a position in Shopify. And I find Shopify to be a much stronger company than Etsy. But it is, however you look at it, a niche player with potential for upward growth. The only problem is the valuation. That has been the case for a long time. For a long time, Etsy was valued with a PE ratio of over 50. Nowadays, the PE ratio has even fallen to 22. Nevertheless, if we look rationally at the facts based on the forecasting tool, we see that the EPS expectations are not shockingly high. This is also based on what management has indicated. So, an EPS growth or earnings per share growth of 12% and 17% in 2026 is not enough to justify a PE ratio of around 30. However, it may justify a PE ratio of around 20, because a PE ratio of around 15 would be very low for Etsy. But the stock is still in a negative trend. Now suppose that Etsy is indeed worth a PE ratio of 15, even with the current growth. Because the price is on the high side, it would yield a possible return of minus 5% per year and minus 10% in total. Assuming a PE ratio of around 19.5, Etsy could provide a slight return from this level, but this is not at all interesting compared to all the other potentially interesting stocks, such as Evolution, which I have highlighted in the news alongside other stocks, and which I believe is much more interesting than Etsy. But however it was turned around, Etsy does have interesting features. For example, the luck ratio is around 1.26. The only thing is that management needs to do something, or there needs to be a macroeconomic stimulus that encourages people to spend much more at Etsy. At this moment, the revenue growth is simply not good enough. As a result, the valuation is also not very attractive, although the price to cash flow of 10 for next year is not on the very high side. But it is also equal to the sector median in value when compared to others. And that is a very important point. It is also an important point, although the market share of 6 billion is on the smaller side, it is interesting for the growth potential that comes with it. That they also have 2.4 billion in debt. So the enterprise value is 7.3 billion. While they do have 1 billion in cash position, the debts are also somewhat on the higher side. However, this is not really a problem compared to the EBITDA, so the debt to EBITDA ratio is below 3. That's just fine. However, I think there are many better stocks than Etsy, especially when it comes to growth. For some reason, the stock just cannot resume the growth it achieved in the past period. The 5-year on-average growth rate from Etsy is indeed impressive. For example, looking at the EBITDA growth. The 5-year average was around 50%, and for the following years, it was even 20%. Today, we actually see that the EPS expectations are around 3 to 5 years regarding CAGR. About 10% is so not very interesting overall when you compare this to other stronger companies with a better, stronger competitive advantage or a stronger mode. Now, that net income margin is also not extremely higher than the sector median. Although this is a 6% outperformance, you must understand that there are also quite a few other types of companies in that sector median. Etsy is primarily classified in the consumer discretionary sector. Well, there are also many non-scalable online earning models involved, so that 10% net income margin is not very interesting at all. All in all, we are not super enthusiastic about Etsy. It is a nice website. It does have real economies of scale. It operates in the niche. It is the niche market leader. This has allowed it to grow. However, as investors, we see better opportunities in other companies. Visit our site for that. Weekly value, dividend, and growth analyses. And I think that they all offer much better opportunities than Etsy at the moment. However, the stock is starting to become attractively valued, and it may possibly grow in the long term simply because of their position in the market and that strong backing. Zexrank indicates it is a hold for us, and their price target is set at $60. This corresponds with the other sources we just saw. They provide various benefits. Reasons to buy, but also reasons to sell. Perhaps it doesn't matter. Interestingly, the current price line is well below the EPS trend line, which is always favorable to see, but we have already seen with fast grabs that the growth potential is rather modest. Unless something happens that causes Etsy, for example, to launch something radically new and resume rapid growth, the PE ratio will naturally rise in anticipation of further growth. As long as that doesn't happen, it remains a very long, slow, boring, and painful journey for investors in Etsy. Since 2023, the stock has decreased by 64%. It can get even worse. Since the peak mania in 2021, the all-time high for Etsy has dropped by 82%. The price level is now even around that of 2018. It will take a long time. I think Etsy is starting to become interesting for long-term investors now. It is possible that in the short term the stock may decline a little further, making the valuation even more attractive. We have seen that the luck ratio is around 1.5, not super attractive, but also not extremely high for a company with a moat like Etsy. So yes, it is starting to get interesting. However, I personally see much better opportunities in other stocks. Also, follow our stock analysis and my own portfolio updates, which I believe have a better chance than Etsy. Thank you for watching, and definitely let me know what you think of this company.